I'm Jean Chia and this is Bank of Singapore Research. Markets continue to be buoyant as the latest CPI print fueled the popular narrative that the US is now entering a period of rapid disinflation and that a soft landing lies ahead. We remain of the view that inflation could still remain sticky in second half 23 and that the Fed will need to keep the Fed funds rate elevated for the rest of the year. Our base case is that a recession is required to return core inflation to the Fed's 2% goal. The corporate reporting season has kicked off, with results coming in mixed thus far. Company fundamentals remain broadly intact, but we're somewhat cautious on the outlook ahead amid elevated valuations, lofty investor expectations across pockets of the market, and cracks in high-end consumption. We favour the healthcare, consumer staples and utility sectors within equities. These sectors enjoy undemanding valuations and are expected to remain relatively resilient as global growth slows. China's macro data continues to disappoint. In contrast to the first quarter of 2023, when GDP rose strongly by 2.2% quarter-on-quarter, China's reopening in the second quarter has lost momentum, with the economy expanding less than expected at 0.8% quarter-on-quarter. The post-pandemic recovery has slowed as consumers have turned cautious, firms lack confidence, and the property sector has stayed subdued, with exports contracting. The policy tone from the recent July Politburo meeting was more dovish than expected, but there still remains an absence of large-scale stimulus measures to sufficiently rekindle growth momentum. All considered, we maintain an overall defensive stance in view of an uncertain global growth outlook. We hold an overall underweight exposure to global equities, staying neutral in US and Asia ex-Japan, underweight in Europe, and overweight in Japan. In fixed income, we remain overweight on US Treasuries and developed markets investment-grade bonds, neutral on emerging markets bonds, and underweight in developed markets high-yield bonds. We also believe that gold plays an important role in diversifying investment portfolios, particularly as a safe haven during periods of market volatility and as a hedge against inflation and debasement risks. For more information, please refer to our monthly investment guide titled Opportunities Amid Uncertainties.